Which is a better trading strategy? Is it ICT or is it order flow? Now, you can make money with any strategy. However, the point of this video is to compare the similarities between both of these strategies and understand which strategy shows the true market mechanics of how an auction works. Now, I also want to mention I've never used ICT. I am not very educated in it. However, for the concept of this video, I did a little research and we're going to see a lot of similarities between both ICT and order flow. The first thing every individual trader has to understand, regardless of your trading strategy, is we must understand how a market actually works and how a market is very similar to any other auction place out there. Any market or any auction simply moves up and down because of transactions occurring. What we can call transactions in the stock market is essentially the volume. How many traders are buying and how many traders are selling. That is the only way any market or any auction can move up, is if there is transactions occurring in that marketplace. Simply, the market moves up because there are more buyers hitting the offer. There are more aggressive buyers than sellers, and the market moves down because there are more aggressive sellers hitting the bid than there are buyers. That is the only way price can change. Even if the market's controlled by an algo, we can spot the volume patterns, we can spot the transactions. Because if there was an actual algo in the market, whether you believe that or not, I do believe there are many algos in the market controlling prices. However, we can spot these algos transacting, and we can spot when they are buying or when they are selling through the order flow or through the volume, because the transactions essentially are the footprints, regardless of an individual or regardless of an algo transacting in the market. Essentially, the market moves from imbalance to balance, from fair value to unfair value. This is how any auction or any market works, similarly to a car market. So anything that's related to volume is actually how prices change up or down. It's how and why the market moves and how it auctions. If there wasn't buyers and sellers actually transacting and there wasn't volume in the market, then the market would be stable and there would be no such thing as a market, because what makes a market true is transactions and individuals buying or selling. Anything that's not related to volume is just another method or just another way of trading, which provides probabilistic patterns that offer opportunities to trade. So whether you use, let's just say, chart patterns or ICT or moving averages, they just simply are methods of trading which offer probabilities, where the probabilities are providing opportunities for you to trade on the correct side of the market. However, if you deal with a trading strategy that relates to reading the volume, this is going to provide the truest form of market mechanics of an auction. Because if you think about it, any other trading method, such as ICT or any moving averages or Fibonacci, will provide opportunities for other participants to be present in the market because they are finding opportunities. Their definition of how they are perceiving opportunity will cause them to buy or sell. So regardless of the strategy, transactions or volume will still come in. And we can read these transactions regardless of the strategy through volume, through its most authentic and organic way. Regardless of the strategy, the volume opportunities will be there. So after doing some research on ICT terms, the term liquidity can be very, very similar, but also a little different to how the actual term of liquidity is represented in the market. So the one thing that I agree on with liquidity is how the market will essentially break highs or break lows to pick up liquidity. So when ICT traders use the term liquidity, I essentially a lot of the time see it with buy side liquidity or sell side liquidity. Essentially what this is the market breaks resistance or breaks a high or a low for traders to pick up liquidity, where either shorts have their stops positioned at or longs have their positioned at. And where there is pain in the market, where traders are stopping out at, that provides a great edge that we can look to capitalize on reversals with. The market picks up this liquidity to accumulate or distribute some positions where the stops may reside. Completely true. However, saying there's liquidity above a buy side or below a sell side, or above a resistance high or below a support high, is not very accurate in my opinion. What I mean by that is, let's validate the concept first. Here we could see a clear high of day where the market has rejected, and then the following day also could not find strength to get above it. So the level that I had on my charts was 52.72 on the S&P 500. My plan the following day was to look for sellers above 52.72, that if some sellers can appear, I am interested in taking the market short. And these are screenshots from my community of my pre-market plan and my commentary in real time as the market is developing. What I was watching for was a breakout to find sellers to play short. Why did I want to see that? Well, I know a lot of traders will place their stop losses above the high. If the market breaks the high and new longs buy the breakout and become trapped, and shorts stop out above the high, we have two periods or two influences that liquidity is being picked up for a possible reversal for the market to drop to the downside. So the term liquidity is true and the term liquidity is valid. We pick up the stops for the market to reverse, as these are areas where traders are proven wrong and they want to get out of their trades. The market tends to break these levels to pick up liquidity, completely true. However, this does not mean liquidity is there. We have to understand the difference between liquidity and illiquidity. Majority of reversals come from areas of illiquidity. So yes, the market is breaking the level to pick up liquidity. However, just because it broke does not mean there is liquidity there. The reversal will come when there is a period of illiquidity, and that is a very, very key concept here. Majority of reversals come from areas of low volume. Low volume means nobody cared about the market at that price. And a lot of the times you can see this from a market profile or a volume profile in the concept of a volume tail. What this means is the market either A, did not spend much time there. If the market doesn't spend a lot of time, that means there wasn't a lot of transactions occurring or there wasn't a lot of volume. If there isn't a lot of volume, that means nobody has cared about the market at that price. If the market doesn't care about prices at that level, then it's a good sign a reversal is coming, validating our breakout or breakdown which failed. How a market works is the market moves up until the last buyer buys, and the market moves down until the last seller sells. So if you were to look at every high or every low, majority of the time that reversal comes when the last buyer buys or when the last seller sells. Think about this. If there's no sellers left to sell, then the market has to move up. If there's no buyers left to buy, then the market has to move down. Just think about it. If the market's moving up and the prices of, let's just say, cars are going up and up and up and up, and then we come to a level where no buyers are interested in buying the car at that price, well, that means there's no volume there because no buyers are willing to buy. And if you're a seller or a manufacturer, you're going to have to lower the prices of that car because there were no buyers left to buy. And you lowering the price of that car simply means the price has to go down and the market reverses. And this is, as traders, how we look to capitalize on reversals of periods of illiquidity once the liquidity was picked up. As we can see here, the intraday commentary, essentially in the community, I just update my thoughts in real time of what I'm watching and how I'm trading it. The market breaks that 52.72 level. There was some really large selling, and I got short at 52.71 with a 2-point stop loss for an 11 to 13 point drop reward to the downside. Excellent risk to reward, simply breaking the level, buyers becoming trapped, and sellers stopping out on that high of daybreak. For sellers have to stop out, they have to buy. So technically, sellers are buyers. Here's a 1-minute chart of the level breaking and an immediate fail and immediate reversal to the downside. Now, what this looks like on the order flow is once that 52.72 level does break, right? You could see 52.72 here, and this now is a depth of market all the way to the left. In my opinion, it is the best tool that any short-term trader can use because reading the volume will provide the clearest, truest picture of the market. So here 52.72 breaks, right? We could see it breaking on the depth of market at 52.72. We could also see it on the heat map of this green line. And as it breaks it, it leaves a sign of rejection. What I mean by a rejection is there is low volume. When we see low volume, it means that the market is very illiquid. And when the market is very illiquid, that means there's not a lot of volume. Nobody cares about the move coming up here. And it's a good indication the market may want to reverse, where we can look to capitalize on a short side reversal to the downside. Now, validating this concept even further, when the market rejected this level over here, followed by that strong drop, the following day, the market breaks 52.72. It picks up liquidity by breaking it, and it shows there's a lack of liquidity there, indicating a good reversal and a potential high in the market at this upper green arrow, as we could see even an upper wick there, indicating there's not a lot of liquidity and there's some really aggressive sellers trying to bring the market lower. Now, what this looks like on a depth of market, looking to the left of the screen here, we can see a lack of volume, meaning as the market broke out, there wasn't many transactions occurring there. If there's not many transactions for a reversal, especially when a resistance or support level breaks, it's a good indication that the market may want to reverse, because nobody cared about that move. And in this example, there was a large seller there resisting prices higher. So as the market breaks out 52.72, we can see low volume on the depth of market, right? Very small numbers. 16 on the offer, 0 on the bid. 34 on the offer, 0 on the bid, right? And then all the way down, small volume. Looking at the profile, we can see the volume tail over here at the RTH column or CVP column. We can see low volume. We can see sort of a volume tail. And the lack of volume shows and provides the tail showing liquidity was picked up. The move was very illiquid because prices were very unfair, forming an imbalance. If prices agreed with the market breaking above this level, we would see fair prices and we would see balance, indicating the move was accepted. However, since the market broke the level, we see unfair prices in a form of an imbalance of lack of liquidity or a volume tail. Now let's talk about FVGs, fair value gaps, and low volume nodes. Now, I have zero clue what a FVG was until a few weeks ago. People would always say, hey, Carmine, you use fair value gaps, and they would send me their chart, and I would not see a gap on the chart. So they would send me like a 5-minute chart. I would see 0 gaps, and I'll be like, what the heck are you talking about? But after doing some research for this video, what a fair value gap is essentially it's created when there's an imbalance in the market by a sequence of candles where we see a very large drop or a very large rally to the upside. This price action results in strong selling or strong buying pressure, essentially leaving a displacement in price where candles have a really large body or very short wicks, indicating there's very little disagreement between buyers and sellers. Now, I'm going to have to disagree with saying that there was a little disagreement between buyers and sellers, because if there was a little disagreement, which also means there was an agreement, then that means the market would essentially be sideways or be balanced. Because there was a disagreement and either buyers or sellers were stronger, that's what caused the market to move up or down. So disagreement, or the market being unfair, is where we get the moves up or down. When we see little disagreement or agreement, this is when the market's balanced and moves very sideways. So after reading that and understanding what a fair value gap is, would it be safe to say that there is a fair value gap here at 52.18 to 52.08-ish, highlighted by these green lines? The market rallied up, creating a fair value gap. As the market was rallying up, there was a disagreement between buyers and sellers, causing the market to aggressively move up higher, especially with this market bouncing off of this demand zone right over here. Now, what this looks like using volume and how these two are kind of similar is majority of the time, after doing some research, is these fair value gaps are essentially low volume nodes understanding volume patterns. Because as we can see here, is as the market rallied up, right? What this looks like right here is these 3 green red candles to the upside is represented by all this strong rallying up right here. Looking at the depth of market, we can see an area of low volume starting at 52.17 all the way down here to 52.12, right? We can see the market rally up, leaving an area of very, very low volume. So now we have an area of a low volume node, which also validates why the fair value gap was created. So areas of low volume on continuation moves means that one side lacked interest in the market. This usually indicates the opposing side was strong and aggressive where there was large buyers or sellers. This is the disagreement between buyers and sellers. The disagreement is, hey, buyers are very strong here, causing the market to rally up with ease, and the sellers lacked interest in the market. Perfectly validating this, as the market rallied up, the buyers were very aggressive hitting the offer, which caused their aggressiveness to make the market move up with ease because of the lack of selling pressure. So now we have a disagreement where buyers are stronger, sellers are weaker, sellers are not willing to sell at these prices, leaving an area of low volume at 52.17-ish, 52.18, all the way down to 52.12, 52.08. So this becomes an area of low volume. Ideally, these levels can act as magnets of support or magnets of resistance. Here on this day, somebody put in my Discord, Carmine uses fair value gaps. And this honestly made me make this video because every time I take a trade, people are like, hey, you use fair value gaps, or hey, you use ICT? And the answer is no. It's just the concepts of a market's auction can be very, very similar. So what I was watching for here was a sell-off as the market dropped into this 52.15, 52.18 level, where if we can pull back into it, I am interested in taking the market long. Now, my analysis was simply based off of this low volume node here acting as support if it was tested. My analysis was not based off of a fair value gap, but that goes to show you that the concepts of this form because of the market's auction. If there wasn't buyers or sellers transacting and there wasn't volume patterns present in the market, then there would not be such thing as a fair value gap. The fair value gap forms because of the low volume node. The low volume node does not form because of a fair value gap. So because of the volume, we get the other trading methods and the other trading strategies. If it wasn't for the volume, then there would be no such thing as, let's just say, a fair value gap. Now we have another thing called a displacement. This is kind of similar to a fair value gap, I believe. Correct me if I'm wrong in the comments. However, comparing this to a low volume node, what we see a displacement as essentially as an imbalance in the market. What this means is there's a single or group of candles that are positioned in the same direction, down or up. So saying that there's a very little disagreement doesn't really make sense, because if there wasn't a disagreement, then the market would be very stable. But because there was a disagreement and sellers were stronger than buyers or buyers were stronger than sellers, that disagreement caused the displacement or caused the market to move down or up aggressively. So after this strong drop to the downside, is it safe to say that there is a displacement or a fair value gap that formed here around 52.40 to 52.55? Strong drop down, strong aggressive body candles to the downside, indicating that there's strong aggressive sellers disagreeing with the market being there. What this looks like on the volume patterns is as the market's aggressively selling off, right? We could see large red bubbles indicating really large aggressive selling. On the profile, we can see an area of low volume at 52.40, 52.55. And on the depth of market, we could see the same thing around 52.39-ish. We could see low volume right here, right? Starting at this green line and moving up, an area of lower volume. So strong selling hitting the bid brings the market down and forms a low volume node because of how aggressive the sellers were. There is large selling in this area, and because of how large the sellers were, indicates that the market moved down with ease, which is what validates that area of low volume because of how aggressive the selling was. The market rallies up into this level, rejects it perfectly, and sells off. Again, this is how the two terms are kind of synonymous, where because of the volume patterns is what causes these, let's just say, ICT concepts to form and validate. So being able to spot these using volume patterns or using the order flow or using a time and sales in level 2 will provide you with the truest and the most clearest picture of the market. Anything related to the volume is how the market moves. If it wasn't for the volume and it wasn't for the transactions and it wasn't for buyers and sellers, then there would be no market and there would be no auction. Anything not related to this is just simply another method of trading, which provides patterns that offer opportunities to trade based off of your own probability scale. So wouldn't it make sense to go with the truest, clearest, and most authentic form of the market's auction by reading the volume and validating it with any other methodology you use. And this is what I recommend. So remember, there's no strategy that's better than another. The point of this video is just to open your mind and understand how the market actually works and how terms can be synonymous. And there's no one strategy that's better than the other. However, the truest picture of the market will be understanding the volume and the transactions occurring. If you have any questions, let me know in the comments. If you enjoyed this video, you gained anything out of it, all I ask is you drop a like and subscribe to my channel. And that's it for me. Peace.